David Weaver, Megan Wall, and Tom Pop. Securities offered through HD Vest Investment Services, member SIPC. Advisory services offered through HD Vest Advisory Services, 6333 North State Highway 161, 4th floor, Irving, Texas, 75038, 972-870-6000. SWC Wealth Management is not a registered broker-dealer or independent investment advisory firm. It's now time for User-Friendly Finance with Dave Weaver from SWC Wealth Management on News Radio WHP 580. If you have a question for Dave, call 540-0580. Now with today's show, here's Dave Weaver.
Hi, good morning. This is Dave Weaver and Megan Wall here with me today on User-Friendly Finance.
Good morning.
Good morning, Megan. How are you today?
I'm doing very well, thank you.
Well, very well is good.
I mean, I wouldn't be upset if it was slightly warmer outside, but sunshine is a good thing.
And the time change doesn't help.
Yeah.
So, yeah, it's a big adjustment. It takes me months to adjust.
Oh, I love it.
I'm a slow adapter.
This is my favorite one because I don't like the other way, but I love this because the evenings being later and the kids can play outside longer. And
speaking of kids, our subject today is going to be education.
Ooh, so, excitement.
Yeah, that'll come into play. So SWC Wealth Management is the sponsor. SWC True North Wealth Management is the sponsor of User-Friendly Finance, and we have two offices. We're located in Palmyra and in Carlisle. Both offices can be reached via our main phone number, which is 717-706-0700, or via the web at swcwealth.com. Our long talked about website is now up and running. We're still making some additional changes, but it's starting to reflect more of what we were trying to do with the website. There's some good information, a picture of the team, a good talk about the services we provide, which are the full range of services you'd find at any financial planning firm. We do retirement planning and estate planning, college planning, which we're going to talk a little bit about today, education funding, tax planning, which we're deep in the throes of. We talked about last week about taxes and the things that people are looking at as they try to put together their tax plans. We help people with evaluating their 401ks, rollovers if they are severing service and want to look for different investment options outside of their retirement plans. Insurance, which includes not healthcare typically. We're licensed to do healthcare, but we don't offer it. We have some people we can refer people to. Life insurance, equity annuities, equity index annuities, variable annuities, the whole range of annuity insurance products, and then life and long-term care. Those are the general areas that we cover. And I wanted to just one more time. I guess we'll talk about it a couple more times. We're putting on a seminar on March 21st at the Bosler Memorial Library from 6 to 9, Retiring on Purpose. And the subject of that is how to navigate the transition from your working life. One of the big things that we focus on is trying to picture your retirement future, trying to create your own purpose statement and take steps towards living a purpose-filled retirement. And we already have quite a few people signed up for that. So if you're interested in that, try to get your name in. And you can do that either at 717-706-0700 or via the web at swcwealth.com. Or we have a registration phone number, which is 800-457-1367. Again, that's 800-457-1367. It's at 6 o'clock again at the Bosler Memorial Library. We'll have not dinner, but light refreshments and hors d'oeuvres. You'll also have a chance to meet our team. Megan and I and Tom will all be there. And if you have any questions about retirement, feel free to come in and register. On our website, you go into swcwealth.com. We have an events tab now at the top, and then there's a registration link at the bottom of the page. Did I miss anything?
I don't think so.
Okay, good. Okay, so that seminar again is going to be March 21st at 6 p.m. at the Bosler Library in Carlisle. So I highly recommend it. I think it's going to be a good event, a good time, good discussion, and a chance just to talk about things that you don't always think about every day and until you're ready to retire, and then it's too late. So
sometimes.
Sometimes it's too late. You want to think about it ahead of the fact. So what we've been doing over the last, other than a couple of tax shows we've had to give people a chance to ask about taxes, are the 8 wealth management issues. And we've gone through some of those so far. We have 8. We talked about investment management, and we talked about family risk management. We talked before about cash flow and debt, and we haven't done a ton of discussion about retirement planning, although it seems to creep up in a lot of stuff. Today, we're going to talk about education planning. And then, Megan, what are the last three?
We have legacy planning, business planning, and special situations. Legacy is, what you want to leave behind. Business planning is if you'd like to start a business. Sometimes people like to start a business whenever they do retire, or even, retire from one business early in order to pursue something that's more their dream. That also can be about helping you phase out of your business as well. And then special situations or anything else that might come up. So it can be that RV you dream of buying, but it also could be making sure that you can care for a loved one, maybe a child who will not be able to care for themselves even in adulthood, or helping take care of your parents or something.
And you should
like
be
that.
taking care of your parents. When
I will take care of my parents.
you're a good
Don't
daughter.
you worry.
You're a good daughter.
My husband might not be too excited. Just kidding.
Hey, wait a minute.
He loves you guys too.
Okay, so today we're going to talk about the subject of education planning. And this is, if you have any questions, by the way, you can give us a call during the show. We have our Panera gift cards, which we're still on. We'll eventually, we have $10 Panera gift cards if you give a call and get on the air. But you can call in with a question at 717-540-0580 or 800-724-5801. Again, 717-540-0580. So the subject of education, we've talked about this as kind of an example of things that, some couples, when you're first starting out and you start to think about having kids, and you sort of envision what your plans and dreams are for them. And then when they're born, you start to have bigger and bigger dreams. By the 2s, 3s, and 4s, you start to give up a little bit on the future and just are totally focused on the present. But with the some people have very specific ideas about how they want to educate their kids. And it's if you plan for your kids to go to college, and you almost need to do that anymore, or some post-secondary education to give your kids a chance to truly compete in what's becoming a more and more education-required world, then you want to try to plan for that and help your kids get at least an even footing with all the people that they're going to be competing with. Some people really want their kids they have a plan to pay for all their kids' college. We have some people that hope their kids get scholarships, but that my kid's going to be a football player and he's going to get into school for football, or girls for field hockey, or whatever it is. Other people say, well, they're on their own. I never had a break. They're not going to, they'll have to earn their way too. Everybody's got their own strategy, and not everybody can make that materialize anymore, because the cost of college is so darned expensive. So that's going to be part of the subject today, is what are the different ways to fund for education, what makes the most sense for you and your family, help you try to decide what kind of plan you want to have for educating your kids.
Absolutely, because there are a lot of different approaches, and none of them is, correct.
Yeah, nothing's perfect for everybody.
Yeah, it's very difficult to pay for your children's full education. So if that's not something that you can do, sacrificing your retirement savings in order to do that is not a choice that we would recommend. You want to try to find some meeting in the middle. It's easier to take out a loan to go to college than it is to retire.
It is. Okay, with that, we'll take a break. We'll be back after the break talking about education and planning for education. This is Dave Weaver and Megan Wall with SWC True North Wealth Management and User Friendly Finance.
Let's get back to User Friendly Finance with Dave Weaver on News Radio WHP 580.
Hi, once again, this is Dave Weaver and Megan Wall with User Friendly Finance, and brought to you by SWC True North Wealth Management. And we're talking about the subject of educating your kids today. So, or your grandkids, as the case may be.
Yes. And it's usually, I will say, from our clients and my experience, it's usually a group effort, because a lot of us who are having kids are also still paying off our college loans.
Yeah.
So we're putting money away. I think it's pretty common that people my age are trying to squirrel away something, because we know how huge that burden can be when you first graduate, but the amount that we are able to squirrel away because of paying off school loans is less than we may
Yes,
want
less
to.
than you'd like, or it definitely makes it a decision because now, in addition to planning for in addition to planning your kids' college and your own retirement, you're also trying to balance paying off your college loans, trying to buy a house or maintain your house, trying to raise your kids in the process. So it's a big decision early on for parents. And if you wait till they're juniors in college or juniors in high school, it's going to be too late to plan for college. You almost have to start early with college costing. It could be there's a huge range of what the price is, but it's
Mm-hmm.
getting more and more expensive. I think you can count on, for a 4-year college, you're probably counting on about $200,000, maybe a little bit less, but depending on the school you go to, it's a really expensive uh, event, and not everybody can afford to save for that. If you have multiple kids, it makes it even more difficult.
Absolutely. And again, there's not one right answer. Anything that you can do for your kids, I would imagine they would be very thankful for. But you do want to set them up knowing that. So,
Yeah, so
you
you're
know,
not surprised.
them leaving for school to get a degree at a very expensive liberal arts school and finding out, when they're filling out paperwork that you're not helping
Right.
could be a big blow. So I would say talk about it as soon as you start talking about colleges. Talk also about their funding
Yeah, here's
options
some,
or lack of options.
right. Okay, so one of the things we're going to talk about today are 529 plans, and one thing that we have to mention as we talk about 529s is that every plan is state specific, meaning and we'll talk about a variety of things, but I need to get the disclosure out ahead of time about
Mm-hmm.
529 plans and some of these savings plans in general. But 529s, we're in the state of Pennsylvania, so we have a state plan that allows you to invest in various options. We also have a TAP program, which allows you to purchase credits. Before you invest in your state's plan, in any state plan, you should compare the state of Pennsylvania plan with the program of any state, and the advantages that both may provide from either a tax standpoint or a benefit standpoint. And any time you think about 529s, you have to think about the fact that it's specifically intended to be for college, so that if you don't use that money for education, it will be taxed to you and penalized as you take the income for a non-college expense. So we always want to make sure we have that discussion with people.
Yeah, and the penalty is a 10% IRS penalty, just
Right.
like taking money from an IRA early. Additionally, it can be for any post-secondary qualified expense. So if your child decides not to go to school to a traditional college but goes to a trade school, it is still able to help with those costs. And we believe that most jobs will have some post-secondary education in the future.
And requirements, a lot of them are going to have, for the higher paying jobs anyway, the jobs that people typically look at as careers, a lot of those are going to require some kind of post-secondary training. Electricians, plumbers, all those require training before they get up and started.
And are in very, very high demand. Machinists. Additionally, we can talk about this when we get to specifically talk about 529
Mhm.
plans, because we're going to go through the list. But we do always have clients who have the question of, what if my kid gets a full ride and I have a 529 plan? Or what if one child doesn't go to school? Things like that. So there are ways that you can still use that money in a non-taxed and penalized way.
Right. Okay, so there are multiple options for trying to fund college, and we get this question a lot. And we talked about before, there's no right answer for everybody. There's multiple ways that this can work. The first and most common one that we talk about when we talk about college are 529 plans, which we spent a little bit of time in talking about the generality of it. But we'll cover that in more detail. A Coverdell Education Savings Account. There are certain types of savings bonds that allow you to use the money that you've earned, the money that would ordinarily be taxable. You can use that for education. And again, it's only certain bonds, and they have to have that be purchased during a specific time and be a specific type of bond. People use Roth IRAs, traditional IRAs, UGMA and UTMA accounts, which are accounts that are for your children, as long as they use them for, not if they use them for education, but
Right.
their kids that are accounts that are in their name but intended, to be transferred to them when they reach the age of majority in whatever state you're in. And then mutual funds are the last way. Those are at least the 7 we're going to try to cover today. It's a lot. It seems like a lot to cover, but
Yeah. I have an even longer
I think there probably is a longer list. But these are the
Mhm.
ones that we would
most
deal with.
use.
Yeah, we would use most commonly. So a 529 plan. I started to talk briefly about a 529 plan. Again, this is the most common one that we think about because the money is, you put it away early, it becomes tax-free. One thing that's a little confusing to people is every state has a plan, and not all plans are offered by the same company. So Virginia, for example, uses American Funds, Pennsylvania, Vanguard. Every state has one and sometimes 2 or 3 different companies that are supporting their plan. Typically, money can be used from a 529 can be used in other states with the same benefits that you have as if you purchased the plan in your own state. That's not always true. A lot of the TAP type programs, which are buying tuition credits, aren't applicable to all schools in every state. So you want to make sure that if your child is intending to go to a school that may or may not accept those credits, you just want to know the answer. You don't want to start buying a bunch of credits for a school that they may not ever attend. So then you're sitting there with all these credits that you may or may not be able to transfer.
Yeah, when they talked about making sure with your state, so there are certain states who have a state plan and will allow a tax deduction for contributions to that state plan, but not allow a tax deduction for contributions to other plans. Pennsylvania is not one of those states, so in Pennsylvania you can get a state tax deduction for putting money into a 529. You can choose whichever program you want, but depending on your state, that's not always the case.
And New Jersey is an example one that they only allow them the contributions for contributions in their own state.
They actually, I just looked into that because that's what I was
Right.
told, but I just talked to a tax guy in New Jersey and he
Right.
told me none of them are tax deductible when you put the money in, but
In New
they
Jersey?
are tax free when you take the money out.
Gotcha. And in Pennsylvania, we have a 3%, a 3% deduction because that's our state tax rate. So there's a supplement to your Pennsylvania state income tax return, a schedule that goes and feeds into your state return that gives you the actual deduction on your tax return.
Mm-hmm. But you do want to know for if you're contributing to grandchildren's plans and stuff like that, the best plan to set up with their parents. And also you want to keep track of what you put in there so you get credit.
Yeah, you want to definitely make sure you get credit if you're putting the money in. So again, it's the deductions. You're still paying tax on the money you put in from the federal standpoint, but you're not paying tax on the earnings that come from that as long as it's used for higher education. And higher education, up until this 2018, was only considered post-secondary education. They've now changed the rules to allow you to use that for K through 12, up to $10,000 a year. But the intent initially was definitely for college education. I haven't really heard. I have not done any checking yet to see if Pennsylvania has that same allowance to be able to use that money tax free for K through 12. That's a federal rule, not a state rule, and not every state has agreed. I think some states automatically comply with the federal law, but Pennsylvania isn't one of them. Their depreciation, as an example, is different for the state than from the federal, and some of the loss rules are different for Pennsylvania. So I'm not sure yet about Pennsylvania's rules regarding using your 529 money for K through 12.
So this point, we'll approach it as a college planning tool.
This we'll talk today about it just using it as a college tool. In Pennsylvania, it may or may not be able to use for K through 12. We're thinking at least federally that will be tax exempt. With that, we're gonna take a break, come back to 529s. Maybe Tom was right. Maybe this will be a 2-week show about education. This is Dave Weaver and Megan Wall with SWC True North Wealth Management, and User-Friendly Finance. We'll be back after the break. Hi, this is Dave Weaver and Megan Wall again with User-Friendly Finance, brought to you by SWC True North Wealth Management. And again, we have offices in Palmyra and Carlisle. You can reach either office by calling our 717-706-0700, as I just mentioned right before we came back from the break, or you can reach us via the web at swcwealth.com. We do try to get back to every show, every call within 24 hours, or every email within 24 hours. And if you have any questions about education planning as we go through this today, our call-in number 717-540-0580 or 800-724-5801. Either one will get you in. We have $10 Panera gift cards if you call in and have a question, and we get you on the air. So we were on the subject of the 529s. We're just early into that. We covered the 6 different ways to save, or 7 different ways to save, but we're going through them kind of one by one. And we're starting with the 529 plans. And a lot of people use the gifting process to try to fund the 529s. You can gift up to 15,000 hours a year. We've talked before on the show about the gift tax and how it's not really a tax to the receiver or anything like that. We'll cover that another day, but you can give up to $15,000 per year into a 529 plan via the regular gifting process. Yeah, per person.
So if you're a married couple, you could do 30 per child if you wanted to.
Right. So
it's not a common.
Yes,
but
it's not too common. Yeah, you can do up to $15,000 per child per donor, and you can also. The IRS has special provisions for 529 plans where you can actually prepay 5 years, which would mean you could do $150,000 at once. Then you can't make another gift within that, but you can still contribute to the 529, but you can't make another gift within that 5-year period. So it's letting you pay all your, get your 529 credits in early. And if you put in for 5 years and you still don't think that's enough money, you can put in 5 years more at the end of 5 years. Mm-hmm. That's very uncommon. So
yes.
It's uncommon for people to do one version of $150,000 per kid. But again, you can do it per person, per donor, or per donor, per donee. The money that you put into a 529 plan is you use after-tax dollars, so you've already paid tax on the money. You put it into a 529. The gift doesn't preclude you from tax. Excuse me, it just is part of your regular gifting that you are able to do to your child.
Similar to contributing to a Roth IRA. So any growth in that account would be tax-free as long as it's used for a qualifying education expense. And within the 529, there are different options. So Dave had touched on the fact that you could actually purchase credits in the TAPS program in Pennsylvania. You also have investment options and a guaranteed option in the state plan. A guaranteed option is, if you look at long-term numbers, it's not going to compare to the investment option, of course, because if they take away all the risk and they're going to guarantee they're going to give you the same amount for each year that you're invested, it wouldn't be the same result as you would have being invested within the stock market. But then each individual plan has many, many different investment options if you choose the investment platform. So if you invest in an American Funds plan, then there would be American Funds that were available to you. That's probably one of the most common ones that we see. American Funds is a company that's been around forever, and people seem to know it and feel comfortable with it. But many, we've worked with people who have Fidelity, Vanguard,
T. Rowe Price,
Putnam, Hartford Funds. So most companies offer some version of a 529 plan, and in Pennsylvania we see a lot of them because of the fact that you get a tax deduction regardless of what plan that you choose.
And I thought it was really unusual the way that whole process worked, but pretty much every state has their own fund family that they deal with, a fund sponsor. And a lot of times it'll just be their funds that are available. The fund selection is different. That's why some people pick plans from different states. They may have like an affinity for one plan or another, and or one fund family or another. So like in the case of American Funds, you have, and I think the Vanguard as well. Every fund family has their own line of funds that you can select from as you're participating in the 529 that has investment options. And the thing you have to watch for is when you're investing in the stock market to pay for this, if you start young, you have a long period of time, 15 or 16 years for the money to grow. If you wait till the kids are 10 or 12, you have less money and less ability to stand exposure. A lot of these funds or a lot of these plans will let you pick from the whole range of funds they have available, but they'll also have funds that are targeted either based on the age of the child as they go through time. So you might have one that you start with 1 to 5, and then 5. It'll shift the investments as they go through time. So from ages 1 to 5, it might be one investment style, and 5 to 10, it might be another, until they get up to the age of college when the predominance of it starts to be in bonds.
And they really do move to very, very fixed assets
as you get
close to college, because most people, if there was a downturn in the market the year before they left for college, that would be very stressful for them because they don't have the time to recover.
Right.
Whereas when you are getting ready to retire, that money still has to last 30 years. And when you're doing it for college planning, that money, you plan on using it in that 4 years.
Yeah, so it's you want to be careful with your investment selection. You don't want to be cavalier about it.
Yeah, you want to
because
work
you want the money to be there
with someone. And it can seem kind of counterintuitive because even when you get to the end, it's not even all invested in bonds that are getting anything. Some of it goes straight to money market, you won't see cash. So you won't see the growth that maybe that you would have that year before you go to college, but it is really trying to protect your asset. And you do have control over that. So sometimes people don't want that. Sometimes people want that. If you invested in a straight age band, that's the way the progression goes.
Yeah, they'll change over time. And you don't have to change. They'll typically migrate you as you go through time.
Based on your child's birthday.
Typically, we see 529s that are set up in the parent's name. The parent's the owner. There's usually a successor owner, meaning if one parent would pass, it would go to the other parent, but you can name other successor owners. Most plans ask for a successor owner. And the beneficiary is named when you set up the plan. You have to name a beneficiary. You can actually set up a 529 for yourself or for your kids.
Absolutely. And if you wanted to go back to school in the future and you had money to start saving, then that wouldn't be a bad idea to do for yourself because you do get that state tax deduction.
Yeah,
so
no other reason just for the state tax
Yeah,
credit.
if you have a high income, that can make a big difference for you. And the beneficiary can change. So as I said before, if you are in that situation where, one of your children gets a full ride, one, it can still be used for other qualifying education expenses. So it can still help pay for room and board if that's not covered, books, a computer if it's needed for school, that kind of stuff. But additionally, you can always transfer the beneficiary. So
my brother's a good example of this, where he set up 529s for each of his 3 kids. The oldest used the majority of his money. He didn't get any scholarships or anything like that. The second son, the school, I think, was a little less expensive, but they transferred money from the one to fund the other. The youngest got scholarships, so he had more money available. Now they're going back and using his money to fund grad school for the first one.
Yeah, so the boys got together and talked about it and decided that was something that they felt completely comfortable with. So there are different options that you could do. So if that child got a full ride, but you wanted to do something else for them, then, you would have to think of what you might want to do to, make it fair or whatever version you use of that in your house. But
the only thing you want to be careful of in changing beneficiaries is you have to actually change the beneficiary in time to match the expenses that you have with the beneficiary of the plan, because it's only tax-free as long as you use the expenses for the named beneficiary. You can't use one child's to pay expenses for the other. It has to be for the named beneficiary. So that's one of the things that you have to be careful of when you're changing. When your intent is to change where the money goes,
change the beneficiary.
Yeah, change the beneficiary. So with that, we'll take a break. We're still on the subject of 529s. If you have any questions, give us a call in at 540-0580 or 800-724-5801. This is Dave Weaver and Megan Wall with User Friendly Finance and SWC True North Wealth Management. We'll be back right after the break. Wow, this is Dave Weaver and Megan Wall with User Friendly Finance, brought to you by True North Wealth Management. Again, if you want to give us a call during the week, 717-706-0700. You can reach us via the web at swcwealth@gmail.com or swcwealth.com.
That place too.
Yeah, or swcwealth@gmail.com. We get you to our email address. So if you, or you can, our website, again, check it out. We made a lot of updates. I'd like to hear if anybody has any comments on it, just to tell us what you think. We have some limits on because of the software that or the company that we use to do this, but it makes it a lot easier because it's smoother to get things through our compliance department just because everything is sort of pre-formatted. But we tried to take as much flexibility as we could within the structure that we have.
Yeah, to try to make it look more like us.
Yeah, more like us, and make it a little easier to navigate and make the content a little more accessible. So check it out at swcwealth.com. Okay, so we're on the subject of 529s and education planning. Good golly, we may not get past 529s today. Income restrictions. One of the good things about 529s, there's no limit on the amount of income you have before your ability to contribute to them. So that's one benefit for people that are high wage earners. And they're probably, if you're a high wage earner, you're probably not going to get much in scholarships anyway. So you want to be able to put money towards that if you can. In terms of federal financial aid, the money that's in a 529 is counted as an asset of the parent if the owner is the parent or a dependent student. So that's one thing that you just want to keep in mind as you're saving as well. And the investments that you use, like we talked about in a typical 529, not a TAP program, where you have a pretty wide range of investments, anywhere from the most conservative to the most aggressive. We talked about the age-based type of plans. If you use the funds for non-qualifying expenses, like we talked about, the earnings are subject, just the earnings, not what you put in, are subject to a income tax. You'll pay, if let's say you had $10,000, you put in a 529, it grew to 15, you don't use it for education, 5,000 of it would be taxed and penalized at the 10% rate.
Mm-hmm. And so that would be like $5,000 added to your income plus a 10% penalty.
Right.
So you definitely want to try to follow the rules if you can.
$5,000 more of income and a $500 penalty for taking the money out early. So it could be worse. It could be on all the money that you have, but it's only on the earnings. Mm-hmm. So that's not an incentive to do it. It's just one of the rules of how it works. The next area. Do we have anything else in 529s, Megan? That's probably the most commonly used, the one most people are familiar with.
Yeah, I think we've covered most of the basic. I'm sure there's some more specific questions, but if you have them, you can always email us or call us during the week.
Okay, so the next area is Coverdell Education Savings Accounts. I don't know how, and they may even have a different name by now, but those are going to be less and less used as the 529s are now going to be able to be used for K through 12. But the Coverdells have a much lower threshold for being able to put money into the plan, or for the amount of money you're allowed to put in. The value is removed from the donor's gross estate. I think that says if you,
So if you had a federal tax estate problem,
right.
If you had,
I see what it's saying.
Yeah. So, but the maximum investment in a Coverdell ESA is $2,000 per beneficiary per year, combined from all sources. So that means if parents and grandparents are funding that, there's only $2,000 max that you can put in there. So that's why it's a lot less common than the 529.
Yeah, Coverdells were one of the first means of trying to help people save for education, and they were limited. And I think that was the initial contribution limit for IRAs. It was introduced right around the same time as IRAs, and was really just another version of IRAs. We didn't talk as much about qualified expenses. I guess I better hit that back on the 529. The qualified expenses you can cover in a 529, the things you can pay for are tuition and fees, books, computers and related equipment, supplies and special needs that are required just for the classes that you attend, room and board for a minimum of room and board for students that are at least half-time students.
Mm-hmm.
And if your child goes off campus, you can only use expenses up to the equivalent that you would pay on campus for on-campus housing. So we've run into that, and you can only claim that for, like, if your child ends up at a semester at sea, but you still had to pay for room and board at both places, you can only claim for the one set of tuition at the institution that they're primarily attending.
Absolutely. And if you have questions about this, ask a tax person before you take the money, because again, people don't like to be surprised by things like this during tax time.
Yeah, nobody likes tax surprises. All those things are the same for a Coverdell savings account in terms of what you can use them for. But you have some additional categories of expenses for K through 12 expenses, and just check again before you actually use it for those purposes. If your kid needs a computer for school or things like that, you just want to make sure they're education related.
Absolutely. And again, the big difference between the Coverdell and the historic 529 is that the Coverdell could be used for K through 12, although they did just change the law on 529s. So.
And one of the things that we want to make sure that we mention too is that when we talked about beneficiaries, the IRS has actually developed a line of people that you can change your beneficiary to. It's like children, parents, yourself, and your spouse. Certain, I think it might be even nieces and nephews. There's a whole list of who those people are if you go and actually look at the 529 regs or talk to a financial advisor. The age restrictions on a 529 are kind of unlimited. You can use it at any period of time. And in a Coverdell, contributions can only be made into a beneficiary's plan until they're 18, and the money has to be used by the age of 30. So that's another big difference between a Coverdell and a 529.
And that's why 529s have gained so much popularity over Coverdells in the last few years, just because of their flexibility.
Right, and another thing is that a Coverdell has phase-out limits similar to an IRA, actually more similar to a Roth IRA, that if your income must be above a certain level, you cannot make a contribution to a Coverdell, where a 529 is unlimited in how much you can earn in order to be able to contribute to those. So I think those are probably the primary differences between 529s and Coverdells. We've never really seen a lot of Coverdells. We've seen mainly 529s when people are saving for college. So that's just something to keep in mind. I guess probably the third most common is, well, I guess we should probably talk about UGMAs and UTMAs.
Yeah, and that's
probably the third most common is an UGMA or UTMA account is just an account you set up in your child's name with your intent that the money be used for college, but you can't control the use of that money once the child reaches the age of majority in whatever state you're in.
Yeah, so some people feel that they don't want their child to feel like they have to go to college to get this gift, or grandparents or whatever. And it's universal gift or transfer to minors. That's what the UG or UT, and it depends on the state. What also depends on the state is the age of majority at which time the money becomes theirs. So it's either 18 or 21 is the age of majority in that state. And at that point, that money is theirs. It's like it's in their checking account. They can do whatever they would like with it. So some people like that idea because they don't want their child to think that they, say they have to go to college or anything like that. And other people don't feel comfortable with their children making that decision at that time. But that is one method. It does not give you any tax benefit,
and it's considered
like a education planning does.
Right, you don't get a tax-free use of the money. It's considered an irrevocable gift. It's an asset of the child. A parent can't decide 10 years down the road that, well, the kid's not going to be responsible. I'm going to pull the money back.
Mm-hmm.
Oh, there we go at the end of the hour, for gosh sakes. One of the things we better make sure, again, if you are interested in attending the seminar that we're doing, Retiring on Purpose, Wednesday, March 21st at 6 p.m., call 800-457-1367 to register, or use swcwealth.com, click on the events tab, and you're in, and you can register there. This is Dave Weaver and Megan Wall with SWC True North Wealth Management and User Friendly Finance.
David Weaver, Megan Wall, and Tom Pop. Securities offered through HD Vest Investment Services, member SIPC. Advisory services offered through HD Vest Advisory Services, 6333 North State Highway 161, 4th floor, Irving, Texas, 75038, 972-870-6000. SWC Wealth Management is not a registered broker-dealer or independent investment advisory firm.